Something just changed in the Bitcoin market, and I need you to pay very close attention to what I'm about to say. This is not the kind of move we see every week, and it is not the kind of signal analysts ignore. Over the last several days, a cluster of indicators has begun flashing at the same time. Price behavior, sentiment collapse, liquidity stress, and macro pressure, all converging into a pattern that historically appears only at critical turning points. Bitcoin is trading around the high 60,000 range right now, after falling violently from levels above 120,000 only a few months ago. That kind of drawdown is not just volatility. That is structural damage in market psychology. I want you to think about what that means. When an asset loses nearly half its value in a short period after reaching euphoric highs, the entire emotional structure of the market changes. Investors who bought near the top are trapped. Funds that entered late are under pressure from clients. Traders who were leveraged are forced to unwind positions. And every rally becomes fragile because it is met with selling from people desperate to exit. That is the first broken signal we are seeing. Rallies that fail to build momentum, even when prices bounce sharply. But that is only one part of the picture. The second signal is sentiment, and sentiment right now is collapsing to levels we rarely see outside major crises. Extreme fear readings are not just numbers on a screen. They are reflections of millions of individual decisions. People hesitating, withdrawing capital, delaying risk. Historically, when sentiment falls this far, it means the market is no longer driven by optimism or growth expectations. It is driven by survival. Now, I want you to understand something very important. Bitcoin does not move in isolation anymore. 10 years ago, you could explain most of its price action by looking at retail flows and speculative cycles. That world is gone. Today, Bitcoin is connected to the same macro forces that move equities, bonds, and currencies. Liquidity conditions, interest rate expectations, and capital flows between global markets now shape the direction of crypto just as much as internal factors do. Look at what has been happening globally. Central banks have spent the last 2 years maintaining restrictive policies to contain inflation. Real yields remain elevated compared to the post-pandemic era. When real yields rise, capital gravitates towards safer instruments, and risk assets struggle to attract fresh inflows. This is not theory. We saw the same dynamic in 2018 when tightening financial conditions triggered simultaneous declines in equities and crypto. We saw it again in 2022 when aggressive rate hikes caused one of the largest drawdowns in digital asset history. And yet, here is where the contradiction appears. Despite all of this pressure, Bitcoin is not collapsing uncontrollably. It is holding, stabilizing, even recovering at times. That creates confusion. Analysts are divided. Some interpret this resilience as a sign of strength, arguing that institutional demand is creating a floor under the market. Others see it as temporary stabilization before another leg down, a pause rather than a reversal. When a market sends two conflicting signals at once, strength and fragility, that is when experienced observers become cautious because it means the system is in transition. There is another layer you need to see, and most people miss it. The structure of this cycle is different from previous ones. In earlier years, Bitcoin cycles were dominated by retail speculation and mining economics. Today, institutional flows play a decisive role. Large funds, ETFs, and asset managers now move billions of dollars with a single allocation decision. When these players adjust exposure, the impact on price is immediate and significant. That means the market can shift direction, not because of retail sentiment, but because of portfolio rebalancing in global capital markets. This is why what we are seeing now is so unusual. On one side, fear is extreme. On another side, price is stabilizing. On a third side, macro conditions remain restrictive. And on a fourth side, institutional participation continues to anchor the market. These forces are pulling in different directions at the same time. Markets do not remain in that state forever. Eventually, one force dominates, and when it does, the move that follows is often violent. I've watched markets for many years, and I can tell you that moments like this feel deceptively quiet. Headlines may fade for a few days. Price may move sideways. Volatility may compress. But beneath the surface, pressure builds. Liquidity shifts slowly. Sentiment recalibrates. And positioning changes. Then, suddenly, the equilibrium breaks, and the market moves faster than most participants expect. Think back to historical parallels. In late 2019, Bitcoin traded in a narrow range for weeks before a sudden breakout that caught traders off guard. In early 2020, global markets appeared stable until liquidity stress triggered a synchronized collapse across asset classes. And in late 2023, periods of low volatility preceded some of the most explosive rallies of the decade. Compression often precedes expansion. That is one of the oldest truths in financial markets. So where does that leave us now? It leaves us at a crossroads, not at a bottom, not at a top, but at a decision point. The signal that has appeared is not a prediction. It is a warning. It tells us that the market is entering a phase where small changes in liquidity, sentiment, or macro conditions can produce disproportionately large price movements. I want you to understand this clearly. What is happening right now is not noise. It is the market preparing for its next major move. And when that move comes, most people will say it was obvious in hindsight. But right now, in this moment, while the signals are still forming and the direction is still uncertain, this is when careful observation matters most. Because this is the phase when markets decide their future, long before the headlines catch up. I want you to focus now, because what I'm about to explain is the part most people misunderstand. When markets fall, people always look for a single cause, a headline, an event, a statement from a central bank. But that is almost never how real crashes happen. Real declines are built slowly, layer by layer, pressure accumulating beneath the surface until the structure finally gives way. What we are witnessing in Bitcoin right now is not the result of one trigger. It is the result of months of tightening liquidity, shifting capital flows, and changing expectations across the global financial system. You have to start with liquidity, because liquidity is the oxygen of all markets. When liquidity expands, risk assets rise. When liquidity contracts, risk assets struggle, no matter how strong the narrative appears. Over the past 2 years, major central banks have been fighting inflation with restrictive monetary policy. Real interest rates have stayed elevated compared to the easy money era that fueled the massive rallies in both equities and crypto between 2020 and 2021. When real yields remain high, large pools of capital have an alternative. They can earn returns in relatively safe instruments, and that changes the entire risk equation. I want you to think about how this affects institutional behavior. A pension fund or a large asset manager does not chase momentum the way retail traders do. They allocate based on risk-adjusted returns. When treasury yields rise and volatility increases in speculative assets, the models begin to shift. Exposure is reduced gradually, sometimes quietly, sometimes automatically through systematic strategies. And when enough institutions make similar adjustments, the effect becomes visible in price. But liquidity tightening alone does not explain the speed of the decline we saw. The second force was leverage. Modern crypto markets are deeply interconnected with derivatives, perpetual futures, and margin trading. When prices begin to fall, leveraged positions come under pressure. Liquidations are triggered automatically. Those liquidations push prices lower, which triggers more liquidations. It becomes a cascade. We saw this dynamic in March 2020 across global markets, and again in 2022 during the crypto credit crisis. Leverage does not just amplify gains, it amplifies collapses. Now, I want you to look at another piece of the puzzle that many people ignore: expectations. Markets are forward-looking mechanisms. They price in what investors believe will happen, not what has already happened. During the rally that carried Bitcoin above 100,000, expectations were extremely optimistic. Investors believed liquidity would return quickly, that institutional adoption would accelerate, that macro conditions would ease. But when those expectations begin to shift, even slightly, the repricing can be brutal. It is not the reality that changes first. It is the narrative. And this is where the third force comes in, institutional flows through regulated products. This cycle is fundamentally different from earlier ones because of the scale of capital moving through ETFs and other structured vehicles. These flows can reverse quickly. When outflows begin, they remove large amounts of buying pressure from the market. That does not always create an immediate crash, but it weakens the foundation. Without steady inflows, rallies become fragile and dips become deeper. I've seen this pattern before, not in crypto, but in other asset classes. In 2007, before the financial crisis fully unfolded, markets began to show subtle signs of stress. Credit spreads widened slightly. Liquidity in certain instruments began to dry up. Most people ignored those signals because prices had not yet collapsed, but the structure was already weakening. By the time the crisis became obvious, the underlying damage had been building for months. Something similar happens in every major cycle. The market does not collapse in one day. It erodes. Confidence erodes, liquidity erodes, expectations erode. Then, at some point, a catalyst appears, and the decline accelerates rapidly, giving the illusion that everything changed overnight. Now, here is the contradiction you need to understand. Even as these negative forces were building, there were still bullish narratives circulating. Headlines about adoption, long-term projections, and technological developments continue to appear. And those narratives were not entirely false. But markets do not move on long-term potential during periods of tightening liquidity. They move on capital flows in the present moment. And in the present moment, capital has been more cautious, more selective, more defensive. I want you to imagine the market as a massive ship changing direction. It does not turn instantly. First the engines slow, then the rudder shifts, then the momentum begins to change. For a while, passengers on deck may not even notice, but eventually the new direction becomes impossible to ignore. That is what we are seeing now. The shift began months ago, long before the sharp decline became visible to everyone. And here is the final point you need to hold in your mind. None of this means that the long-term story is finished, and none of this guarantees further decline. Markets are not linear. They move in cycles shaped by liquidity, psychology, and macro forces interacting in complex ways. What we are witnessing is a phase in that cycle, a phase where the forces that drove the previous rally are no longer dominant, and new forces are taking control. Right now, you are watching a market in transition, a market that is repricing risk, recalibrating expectations, and searching for a new equilibrium. And transitions are always uncomfortable, always volatile, always uncertain. That is why moments like this feel chaotic while they are happening. But later, when the cycle turns again, they will be remembered as the period when everything began to change. Now, I need you to look beyond Bitcoin itself and pay attention to what is happening across the rest of the crypto market, because this is where the deeper signal becomes visible. When stress enters the system, it does not spread evenly. It moves in waves, and the first places you see real damage are almost always the most speculative areas. That is exactly what is happening right now with altcoins. You can see it in the numbers, but more importantly, you can feel it in the structure of the market. Capital is not flowing outward from Bitcoin into smaller assets the way it does during strong expansion phases. Instead, capital is retreating inward, concentrating into what investors perceive as the most resilient asset in the sector. That is why Bitcoin dominance has been rising again. And I want you to understand something very clearly. Rising dominance during a fragile market is not always a sign of strength. Often, it is a sign of fear. Think about how capital behaves in times of uncertainty. In equity markets, when risk rises, investors move from small-cap stocks into large-cap companies. During financial crises, capital moves from equities into government bonds. In emerging market turmoil, money flows into the US dollar. This is not random behavior. It is a structural response to risk. Investors reduce exposure to assets with thinner liquidity and higher volatility, and they concentrate capital where they believe they can exit quickly if conditions worsen. In the crypto ecosystem, Bitcoin plays that role. But the consequences for altcoins are severe. Altcoins depend heavily on speculative flows. Many of them have smaller order books, fewer institutional participants, and higher correlation with overall market sentiment. When liquidity tightens, these assets do not just decline. They often decline faster than Bitcoin, sometimes dramatically faster. you are seeing that pattern unfold again. Ethereum, Solana, XRP, and many others may bounce sharply during relief rallies, but their broader structure remains fragile because the capital that once fueled sustained uptrends is not yet returning. I want you to remember the last major cycle in 2018. Bitcoin fell sharply, but many altcoins collapsed by 80 or 90% because liquidity vanished almost completely. In 2022, we saw another version of this dynamic when tightening financial conditions and the collapse of leveraged institutions triggered widespread losses across the entire crypto ecosystem. History does not repeat perfectly, but the behavioral patterns of markets are remarkably consistent. Now, there is another layer to this that you need to understand, and it is psychological as much as it is financial. During bull markets, investors see opportunity everywhere. Every new project feels like the next breakthrough. Risk tolerance expands, and capital spreads outward into more speculative areas. But during corrections, that psychology reverses. Investors begin to question assumptions. Narratives lose power. Projects that once attracted enthusiasm struggle to hold attention. It becomes a flight to perceived safety, even within a market that is itself considered risky by traditional standards. And here is where the contradiction emerges again. Even as altcoins struggle, some of them continue to produce technological developments, partnerships, and long-term progress. The fundamentals of certain networks may remain strong, yet prices decline anyway. That is because markets are not driven solely by fundamentals in the short term. They are driven by liquidity and positioning. When capital is leaving, even strong projects can fall. That is a difficult reality for many investors to accept, but it is one of the most important lessons in financial history. You also need to consider the role of correlation. In periods of stress, correlations between assets tend to rise. This is something we have seen repeatedly, from the global financial crisis to the pandemic shock in 2020. Assets that normally move independently begin to move together because the dominant force is not individual fundamentals, but systemic risk. In the crypto market, that systemic force is Bitcoin itself. When Bitcoin drops sharply, altcoins rarely escape the gravitational pull. And yet, there is something else happening beneath the surface that makes this moment particularly important. The structure of participation in the crypto market is changing. Institutional investors, who now play a larger role than in previous cycles, often allocate primarily to Bitcoin rather than to smaller tokens. That means that when new capital does enter the space, it tends to concentrate in Bitcoin first. Altcoins depend more heavily on speculative retail flows, and those flows are far more sensitive to fear. So what you are witnessing right now is not just a downturn, it is a resorting of the entire ecosystem. Capital is being redistributed, risk is being repriced, and the hierarchy of assets is being reinforced. This process can be painful, and it can last longer than most people expect, because rebuilding confidence takes time. I want you to understand something from experience. Markets do not reward impatience during phases like this. They test conviction, they test narratives, and they test the emotional resilience of participants. Every cycle creates moments when it feels like nothing makes sense, when strong assets fall alongside weak ones, when rallies fade unexpectedly, when fear spreads faster than facts. That is not chaos. That is the market searching for a new balance. And right now, as you watch Bitcoin hold relatively steady, while altcoins struggle to regain momentum, you are seeing one of those moments of recalibration. It is not loud, it is not dramatic in a single instant, but it is powerful because it is reshaping the structure of the market in real time. This is why the signal we are discussing is so important. It is not just about Bitcoin's price. It is about the behavior of capital across the entire crypto landscape. When dominance rises, when liquidity concentrates, when correlations increase, and when speculative assets weaken simultaneously, it tells you that the market is moving into a defensive posture. And defensive phases do not last forever, but while they last, they change everything. Now I want you to slow down for a moment and look at where we actually are, not where emotions are telling us we are. because this is the most dangerous phase of any cycle, the phase where the future has not yet decided its direction, and the market stands in a narrow corridor between recovery and further decline. What we are seeing right now is not a clear trend. It is a battlefield of probabilities, and history teaches us that when markets reach this kind of equilibrium, the next move is rarely small. You need to understand that markets do not move randomly. They move along paths shaped by liquidity, policy, and psychology. If you study financial history long enough, you begin to see the same patterns, repeating in different forms. After every major rally, there is a period of distribution and repricing. After every period of tightening liquidity, there is eventually a turning point. But that turning point does not arrive on a predictable schedule. Sometimes it comes quickly, sometimes it takes months, and sometimes the market tests lower levels before finding stability. So let me walk you through what could realistically unfold from here, not as predictions, but as possible paths shaped by the forces already in motion. The first path is stabilization. Markets sometimes need time to digest a shock. After a large correction, volatility compresses, trading ranges narrow, and both buyers and sellers hesitate. We saw this in 2019, when Bitcoin moved sideways for months before the next major trend emerged. A stabilization phase does not feel dramatic while it's happening, but it is often the period when the foundation for the next move is quietly built. But there is another possibility you must consider, and ignoring it would be irresponsible. If macroeconomic conditions remain restrictive, if real interest rates stay elevated, if global liquidity does not expand, if institutional flows remain cautious, then the market may not have the fuel it needs to sustain a recovery. In that environment, prices can drift lower, sometimes slowly, sometimes suddenly. History shows that markets often revisit areas of heavy trading volume or realize cost bases before finding durable support. This is not a prediction. It is a pattern observed across decades of financial cycles, from equities to commodities to digital assets. And then there is a third path, the one that surprises the greatest number of people when it happens. Markets can turn upward sharply, even when sentiment is still extremely negative. In fact, some of the strongest rallies in history began when fear was at its highest. In March 2009, when global markets were collapsing and headlines were filled with pessimism, the foundations of a decade-long bull market were being laid. In March 2020, when panic spread across every asset class, the conditions for one of the fastest recoveries in modern history were already forming beneath the surface. The reason this happens is simple, but often misunderstood. Markets move not when news becomes good, but when conditions stop getting worse. The turning point often arrives quietly, almost invisibly, and only later becomes obvious in hindsight. That is why the signals we're seeing right now matter so much. Extreme fear, compressed volatility, defensive positioning, these are not conclusions. They are ingredients. What they produce depends on what happens next in liquidity, policy, and global risk appetite. I want you to think about the larger macro picture as well. The global financial system moves in cycles of expansion and contraction. Periods of tight money are eventually followed by periods of easing. Capital that retreats into safety eventually searches for yield again. But these transitions do not happen overnight, and they rarely happen in straight lines. They unfold through a series of false starts, temporary rallies, and sudden corrections that test the conviction of everyone watching. Right now, what you are witnessing is the market searching for its next equilibrium. Institutions are recalibrating risk. Retail investors are recovering from losses and reassessing their expectations. Liquidity is shifting slowly, sometimes invisibly, across global markets. These processes are not dramatic in a single moment, but they are powerful over time because they reshape the entire structure of participation. And this is the final point I want you to remember. The signal that has appeared is not a guarantee of collapse, and it is not a guarantee of recovery. It is a warning that the market has entered a decisive phase, a phase where the next major trend is being prepared, where positioning is being rebuilt, where sentiment is being reset. These are the moments that define entire cycles, but they rarely feel historic while they are happening. Years from now, people may look back at this period and say, the signs were obvious. They will point to sentiment indicators, to liquidity data, to macro conditions, and they will connect the dots easily. But right now, standing inside the moment, the future is still uncertain, and uncertainty is what makes markets powerful and dangerous at the same time. So, as you watch the charts, as you follow the headlines, remember that what you are seeing is not just price movement. You are watching a global market negotiating its next direction, balancing fear and opportunity, weighing risk and liquidity, searching for the point where equilibrium breaks and momentum returns. And when that moment comes, it will not ask for permission, it will not wait for consensus, and it will not move slowly. It will move the way markets always move when pressure finally releases. Suddenly, decisively, and faster than most people are prepared for.